Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. 1 o'clock on the East Coast. For those that said there's no way Swizzle's going to be there tomorrow, given what happened yesterday, here I am. There's Dan. There's Elizabeth. Today's market call, as you know, is brought to you by FactSet, our data provider, and SoFi. Get your money right in one app. But before we even start, I'll say the following. You know, we do a lot of work. We share emails and texts over the weekend. We read a lot. And it just goes to show you, I mean, I can read everything I want, but the amount to which, the degree to which I've been wrong about things is staggering. So I wanted to just throw that mea culpa out there before we get started. However, fear not, because it is Thursday, Dan. And as you know, if it's Thursday, it's butter. So we're going to get his work. And we'll see, but it's going to be fun. I mean, obviously the fireworks of yesterday are in the rearview mirror. The market's picking up on it again today. Dan, Elizabeth, how are you?
Liz, talk to me. Yes.
Yeah.
Excellent.
You guys, I'm guessing, are Seinfeld fans,
Yeah.
not Friends fans.
No.
But there's that episode of Friends where Ross is trying to get a couch up the staircase and it's like, pivot. That meme, I'm sure, got a lot of use yesterday. That's what happened. I guess anything that's bad has been canceled.
Yeah. Well, it is interesting. You know, we've been talking a lot about like financial conditions, the easing of financial conditions, and what just happened over the last, call it 24 hours, at least as it relates to the stock market, at least where it relates to 30-year mortgage rates and how they have come in, I think the first time below 7% in a while. I mean, you think of like, are we like, and Guy, you and I talked about this yesterday. So we're an hour before the Fed decision. We're doing market call. And we said that, you know, like, listen, you know, at the end of the day, you know, some folks think this is like mid-90s stuff where we're on the precipice of a multi-year sort of run. And others think that we are early 2007 sort of stuff with the pivot as far as the rate hiking cycle, the pause, the duration of the pause, and all that stuff. And again, I guess you could only have the sort of violent reaction to the change in one word, okay, in the statement, which was any. Okay. If there was a lot of, I think, trepidation on both sides of this, you know, and Danny Moses has made this point very well for the last month or so, despite also being bearish. He's like, but, and Guy, you said this, and Liz, you've said it, but it might be clear sailing if we get benign data because of the sort of chase that you have into year end and such, guys. So like, you know, like, again, pivot, but like it was fairly well telegraphed. I just like the reaction. And this brings me back to November 1 Guy and November 13, because the reaction on November 13 to what happened on that CPI was also confounding.
Well, I mean, telegraphed in so much as, and Elizabeth has talked about this, we brought it up. I mean, there are 4, if not 5 rate cuts priced into the market for the last couple of months. And, you know, EY has brought up the fact that it seemed, and she's been right about this, they're going to drag it forward. And now, to her point from a month or 2 ago, that drag forward gets you into a March cut. And who knows, you know, what happens even prior to that. So we'll see. But, you know, I'll say this as well. It is fascinating to see how quickly, you know, the euphoria around all clear, mission accomplished, you know, nothing bad is going to happen. You know, I'll say this, as I said, as I started the show, we read a lot of different things, and, you know, you go back and look at history as some sort of guide, and there are a number of different, I guess, points in time that you can pull from. But the data we have seen, and again, we bring up these leading economic indicators and all the different things and the duration with which the yield curve has been inverted. And the longer duration is, as Joe Livornia pointed out last night, if we get to February, it'll be a record in terms of duration. And history says, you know, the longer the duration of an inversion, typically the worse the downturn is going to be and the more prolonged. So we'll see. But let's go to the rundown and get right to it here, Dan, because there's a lot to talk about. As we said, Fed is preparing to shift to rate cuts. Good for them. The market has been anticipating. They got what they wanted. Financials seemingly love that. I understand that on a knee-jerk reaction. And Toll Brothers share buyback, good for them. Or is it are they doing it at the most inopportune time in terms of where the stock is and in terms of the cycle? But let's get right into it, Dan Nathan and EY from SoFi.
Yeah, so interestingly, Guy, I don't know if you caught this on the closing bell yesterday after the Fed presser, EY was on the floor of the New York Stock Exchange. It was interesting. So Jeffrey Gundlach of Double Line just got done speaking, and I'm curious what you thought, because there was like an interesting sort of juxtaposition. You know, Jeffrey seems very bearish, okay, on equities, on the economy, and the prospects for a recession. And he thinks that the Fed did this because he wants to get people prepared to aggressively cut in the face of economic weakness, okay? And then Josh Brown, our friend TRB, came on. He was basically jumping out of his seat in excitement for everything that was going on in the markets and this or whatever, and landed the plane and all that sort of stuff. And I'm not bringing that up poking fun. I mean, like, that was the mood of the market, right? So I'm curious, what was your take? Because I heard you, but I'm just saying, now that you have a little more time to kind of dissect it, I know you talked to a bunch of folks and everything like that, being down there at the moment, it was just an interesting juxtaposition between those two voices. And you came on and you were a bit more.
Well, I mean, it was an emotional moment, I think, for a lot of investors. And you've got a Dow. I know how much you guys love talking about the Dow, a Dow that hit new all-time highs. I mean, you can't deny that, right? And then it just fuels the momentum even further. And I've talked about this for the last couple of weeks. If things don't surprise us to the downside, we probably can rally through year end. And this is a point where, if you really want to be short-termy about it, just ride it. Just let it run. But let the clock run out on it. I think it will run out. And now we're at this point where, the funny part about yesterday, and I didn't get to say this on TV, but the thing about yesterday that I don't think has gotten enough attention is that up until yesterday's meeting, my take has been that Jerome Powell has said, I don't care what the market thinks. We are going to continue this fight. We are going to keep hiking if we want to. I don't care about financial conditions easing. Last meeting, he sort of alluded to it, but he basically had said, that's not what we're watching, right? Then what happened yesterday is the Fed, for the first time in a long time, came closer to what the market was saying. And it was a turn, just a very nuanced turn, but a turn in the sense of, wow, was the market actually ahead of this? Did the market have this right? And if you look, and this is in my note as well, but if you look at what the market expects for cuts and what the Fed expects for cuts, it's still different. And when those two lines are far apart, that's volatility inducing. So yes, we got a pivot. Yes, we got sort of reaffirmation of everything that has driven the rally to this point. And I think that's fine, but I would have to side more with Gundlach.
Yeah, Guy, but here's the thing, and maybe our peeps can pull up a day chart of the S&P 500. The whole idea to get complacent right now after the violence of the rally, after the breakout a couple weeks ago, yesterday's move, look at the gap that we had today and look at the way it's selling off, right? And so to me, like, and maybe they can pull up the KRE. I mean, there's a couple parts of this market that are really outperforming on a day where the S&P right now is basically up 15 basis points, guys. So I think you want to be really careful right now about not being complacent with a 12 VIX and believing that the next 2 weeks is off to the races, because to your point, Liz, we might have had a pull forward of some of this enthusiasm over the last few weeks. Guy, thoughts on that?
Yeah, I could not agree with you more, but yes, I agree with you. And I'm not changing my stance. I'm acknowledging that it's been wrong. But, people will say, well, complacency, or let's put it this way, too much rigor has been the exact wrong thing to be over the last, call it 3 or 4 months. So, why should I be rigorous now when it hasn't paid off to be? And I can understand people saying that, but I'll push back and say the following, and you've said this a number of times, the higher we go into year end, and this is eerily reminiscent of what you said a couple of years ago, the worse it could potentially be going forward into the new year. And I'm still of that belief. I don't think, nothing fundamentally changed in terms of the concerns that I have. I'm sure Elizabeth has, Dan, you have as well. Like, nothing changed. Whatever the Fed is going to do moving forward is probably going to be in anticipation or to try to rectify the things that I'm concerned about. Of course, historically saying that's the wrong time to be looking at the equity market, but there's no denying the animal spirits are back in spades. But I think you're right to bring up the fact that a 12 VIX suggests that although complacency has been rewarded, one has to wonder how long that's going to continue.
Yeah, I mean, listen, so what Guy's kind of also alluding to is that in late 2021, I mean, it just felt really unnatural to us the way that the major indices, the way the SPX was still moving higher. The NASDAQ had already topped out in November. And then under the hood, there was just a lot of bad action. And so I look at today, and if I just kind of, pull up my main FactSet screen here, it's not as green as you would think, right? And there's a lot of laggards that are doing a lot of the heavy lifting. So if I'm looking at GM and Ford up 5% and 6% respectively, Deere, which was trading very near a 52-week low just like a couple weeks ago, is up 4 or 5% or something like that. There's a whole host of other things that just really, to me, smack of like what was gonna, basically what was going on right before we were in a bear market, which was 2022. So, like I don't love manias, and I think what we have right now is a bit of a mania. I'm looking at a Carvana up 17%. I'm looking at a whole, so like that sort of stuff kind of bothers me, and so I get a little queasy here because it's not based on fundamentals. It's based on the dollar coming in. It's based on yields coming in, and that's great. Those are really important inputs to the stock market valuations and everything like that. But to me, it doesn't really say pedal to the metal right here, right now.
Yeah. Okay. So a couple things. I'll start by saying I too have been completely wrong this year about thinking that there was going to be some big event that would take us down. There was an event. I think we seem to forget about that, but it didn't take us down. And wrong about the idea that things were going to cool off and contract much sooner than they actually did. Right now, as we sit, again, remember last week when I talked about the You Are Here Star, guy got all fired up about that. But as we sit on the You Are Here Star, things still look pretty good. And to the market and to a lot of investors, it seems like, you know what, there's kind of even chances that this could go well or this could go poorly. So for now, we're going to choose glass half full. And that's where the optimism is coming from. We can talk about this time is different till our faces turn blue. One thing that I think is never different is that when you have a contraction or a recession or a drawdown that's caused, and you might call it a financial crisis, something that is happening because of what's going on in markets, it is always caused by excessive risk taking somewhere in financial markets. Every single time it is a little different, right? 2008, 2009 was excessive risk taking in mortgage-backed securities. We can rewind and talk about that in a number of different ways. There's two differences here. Obviously, this isn't in mortgages, but this could be, maybe it's tech, maybe it's Bitcoin, maybe whatever the risk taking is, the risk appetite right now that we're seeing is still very, very high, which lends itself to excessive risk taking. The thing that makes this particularly risky is that if you compare it to what happened in the financial crisis, we went into that with the majority of Americans having a lot of their net worth, the majority of their net worth tied up in their home. Now things have changed. They may not have the majority of their net worth tied up in the market, but they've got a lot more tied up in financial markets than they do in their home. And if that's the center of the risk, if it falls, the wealth effect hits even harder.
Yeah. Hey, Guy, just, one thing that we've talked about. So that's really consumer oriented that Liz is kind of describing. We've talked about consumer debt. By the way, Guy, you are not on the big show tonight. I know you have where are you going tonight? You have a big show. You're going to a big show.
Bocelli tonight at Long Hair at the Madison Square.
That's awesome.
Bocelli. I mean, I'm off topic a bit here, but I will tell you that every once in a while, these generational talents come along, and until you've seen that man and heard him sing live, I mean, it's a religious experience. It's the most unbelievable thing. I mean, there are people weeping, and he will sell out Madison Square Garden. I think he started tonight. I think it starts tonight and tomorrow, or last night and tonight, whatever. But people flock to see this man. It's amazing.
That's cool.
Well, it's cool. You go every year, and he gets more excited than he does to go see his New York Rangers in there. But we're having Sheila Bear.
Crowd.
Yeah, we're having exactly. we're having Sheila Bear on, Guy, and I know you always appreciate having her on. I think she's been very candid. She used to run the FDIC, correct, during in the wake of the financial crisis and it'll be interesting to see what she has to say. But one of the things that I think is really interesting, maybe we can pull up Adobe here for a second. We were talking about it on Fast Money last night. I mean, we're looking at that guide, Guy, and we're like, wasn't that bad? You know what I mean? Like as far as, but the stock was up 80% up 100% from its lows or something like that, trading at 35 times expected EPS and sales growth of maybe 12-13% or something like that. And my response, and actually you didn't get to say anything, so I'd love to get your take here, is that like if I'm that CEO, I'm that CFO heading into the new year, I want to strike a sort of cautious tone. Wouldn't you think so, Guy? I mean, like So talk to me a little bit, because and just pulling it all together, my point is that if there is an enterprise slowdown, and we've been talking about this, right? So we started the year with all the job cuts in these big tech companies in particular, but we've seen them across a whole slew of different industries. After that, comes like a subdued buying sort of environment. That's what in companies like this, they're trading at multiples that we have not seen in a very long time. You know what I mean? Like they are vulnerable, in my opinion.
If we could, Jacob and or Steven could do a longer term chart, go back to sort of the fall of 2021 in Adobe and take a look, and you'll see. I mean, we pushed up towards, close to those highs that we saw. I want to say, I'm surprised it was actually in the summer. I thought it was earlier than that, but it doesn't matter. You can see the chart here.
Yep.
And, that was seemingly on the back of a lot of this space was in vogue without question, but you saw how precipitously we dropped, and we regained most of it. The price action today, if you look at that little island type of thing, I have this engulfing pattern there, the highs being higher than the prior day's high, the low now being lower. These are typically patterns that technicians take a look at. To your point, though, specifically in terms of guidance, yeah, why wouldn't you be cautious? I was actually surprised. That was their fourth quarter they reported. They gave full year guidance for 24. I'm sort of surprised that they did it. And maybe that's just something that they've historically done. But you're talking about a year where how can anybody have clarity given what's going on this year? And obviously, given some of the unknowns we've been talking about for a while next year.
Yeah, and pull up the IGV too on a 1 year. And it's interesting, Liz, because this is a group where Salesforce, Microsoft, Adobe, Intuit, Oracle, ServiceNow. By the way, Oracle can't get out of its own way, trading at 5-month lows. Was trading at 4-month lows in late October, and we know the multiples on those names. They gotten kind of fat. I mean, a retracement back to the breakout level that is coming. Whether it comes from a little bit higher than here, you know what I mean? It's coming. So that's my only point, Liz, about complacency right here. Because if there is a fundamental reason to sell any of these, okay, because as we get into Q4 earnings season towards the end of January, watch out below, because everybody is so crowded in these stocks for beliefs of, they don't care about valuation or these secular shifts that are going, whatever it is. So curious how you're thinking within tech. I know that you look at some of the subsectors in a way. Do you want to stick with the ones that have worked? Carter came on yesterday on Market Call and on Fast Money, and he's saying play the semis for a continued momentum breakout. I mean, to me, I'd really only be playing the laggards here that maybe have valuation support.
Yeah, I would definitely be playing the laggards. So what's going on right now, and I think this will affect tech broadly, it already has affected tech broadly, is it's not any new money that's going into the market. It's the same money that's just rotating around from the winners to the losers on the thesis that we're broadening out, everything is getting better. So there's going to be this big catch-up trade, and that's what's going to make this a new bull market. That's what's going to make it durable. And that's okay to ride, but you still have to ride the laggards then, not the ones that have led this market up. That probably continues unless we have bad news, but that probably continues until we have yields and rates come down to a point where it's no longer attractive to sit in a money market and get over 5% risk-free. And that'll happen sooner rather than later if we still see yields dropping like a rock, like they have. I mean, that's just mind-boggling. This more than 30 basis points in the 2-year yesterday, absolutely mind-boggling. But as rates drop, money markets will look less and less attractive, particularly if cuts like this continue to be priced in, and then investors have to make a decision. And that was actually one of the points that Gunlock made on the show yesterday, that when money starts to come out of money markets, people are assuming, the bulls are assuming, that it's going to just flood into some of the names that are already winning. Maybe that'll be semis, maybe that'll be the Magnificent Seven, whatever, somewhere in the tech trade. And his point was, I don't think that's going to happen. I think it's going to go into other bonds. I would say, yes, probably other bonds, but also the laggards if we're still moving up. So to answer the question very briefly, no, I don't think that this year's winners are going to be next year's winners. And I think if you want to buy something, you have to buy the stuff that's trailed.
Yeah. Hey, by the way, I actually think ultimately, if the market does close higher next year, this year's winners will ultimately be the next year's winners. But I think they're vulnerable in a pullback, and they think they lead the way. But Guy, I'm back to what Gunlock was saying too. And again, I've been very wrong on the broad market, and I made this point last night on Fast Money. I mean, there was a time in late October where the S&P had given back, 2/3 of its gains from its highs on the year. And I thought we were going to be unchanged for fundamental reasons. I did not expect this sort of pivot. And I think you're in agreement. But Gunlock said something really interesting. He said, stocks need bonds, but at some point, bonds don't need stocks. Okay. So, and I want to pull up Carter's charts here for a second. And I'd love to get your take on this because Carter is looking at the 2, he's looking at the 10-year yield. I mean, there's clear breaks and he has been all over this. He's been calling for that move. He called for the move, the breakout above 4%, okay, in the 10-year. And then he said, let them go when they got to 5%. And then he kept on pressing. So if you look at the 2-year, and to your point, Liz, there was a much bigger move, right, in the 2s than there was yet last year in the 10s or yesterday. And then if you look at the 10s, so talk to me about that comment, because I think what he's saying is that next year, bonds can continue to rally, but it's going to be, and it's exactly what you've been saying, but that's not exactly going to be great for stocks.
Yeah. And Carter, yes. And these are Carter's charts, by the way, but Carter's point for a while has been there will be a point in this, in this interest rate environment where lower rates become detrimental to equities. I thought it was going to be, again, incorrectly, somewhere around 4.5% on the way down. That proved to be incorrect. But now here we are in the 10-year sub that. But I don't, again, maybe it's not so much about the rate. It's about, the speed with which we get here. And then sort of the inference the market starts to draw from, wait a second, what is really going on here? So I think to Gunlock's point, the bond yields can continue to go lower. That's not necessarily going to be supportive of equities. And before we sort of move on, because I don't think I had a chance to ask Elizabeth about this, but one of the things that she's brought up a number of times, and I think this is interesting, especially in the context of yields, is the one thing the Fed had been watching until yesterday, apparently, was this super core inflation, which, by the way, has sort of reaccelerated. And I was surprised that they took the stance that they did against a backdrop where the one thing they've talked about, Elizabeth, of watching is the one thing that actually is working against them. Thoughts on that?
Yeah, well, I've long believed if you take all the problematic things out of inflation, of course it looks fine. So the super core measure is core, so take out food and energy, and then you take out shelter. And that's the reading that they had talked about as being the most important one. That one actually does look okay. And you'll hear this all over the media. You'll hear a 6-month average of PCE is at 2%. You'll hear all these different metrics actually being at target. The reality is, and what he said yesterday, is that it's still not there. And luckily, they are still watching CPI and not just core PCE. So I think that's going to save consumers in some ways because they're declaring it's not over yet. Inflation is not where we need it to be. And I think that's good. Here's the thing about shelter, because there's been this huge debate about shelter. We're going to take shelter out. The Fed probably has to set policy without looking at shelter inflation because it's so lagging and because this particular cycle has made it a little bit distorted. But consumers obviously cannot live their lives without paying for shelter. So there's this complete mismatch right now, in my opinion, about what the Fed is trying to do and the measures that they're watching versus what consumers are actually dealing with and what consumers are actually feeling. And when my outlook drops tomorrow morning, you will see a chart in there that shows you the cumulative effect of transportation costs, energy costs, food costs, and shelter, how much they've grown since 2019 versus how much wages have grown. Inflation has far outpaced wages. So that's why you get this mismatch too about consumers saying, I don't feel great about the economy. But then you've got the market saying everything's fine, right? Somebody's going to be wrong. And my bet is that the consumer is the one that holds the power here.
Yeah. Well, it's interesting. We brought this up on many occasions, like just look at the political polls, right? Like, so the folks that are being polled and answering the questions don't feel good about the economy. And you would think with the Dow Jones Industrial Average at a new all-time high, which is the measure of the stock market that most of America think about and kind of also equate it to what's going on with the economy. You know what I mean? It's not getting a whole heck of a lot of play. You know what I mean? If you think about it. So I find that pretty fascinating. Talk to us a little bit about the focus of your note tomorrow. I know you were thinking about the dot plots. The dot plots are really where, there's this whole notion that, and I think Steve Leisman guy said this, that, Fed Chair Powell did this pivot because he really thought he was going to lose the voting members of the committee. And
I
so
heard that, yeah.
Yeah. And that's reflective, I guess, that's what, people, when they talk about this dot plot. So talk to us a little bit about your analysis and what you're thinking about it, because sometimes it's really good. I'm sure you took a breath yesterday, you went home, and then you put pen to paper here and you thought about what you're going to do. Like what ultimately, you were saying a week ago that, again, these rate cuts have been pulled forward. What's changed in your mind because you were already there?
Yeah. Not much,
Yeah.
frankly. And they got pulled forward even more. So now March is a lock.
Yeah.
And here's what I would say. Think about 2024. There are 8 Fed meetings next year. Right now, the market is suggesting that we are going to get a cut in 6 of those 8 meetings. That's a lot. So the inconsistencies, I think, are running rampant. And it could be that it turns out the other side of the coin is the one that's correct. Obviously, this year that was the case. But the inconsistencies, and that's one of the big ones for me. Okay, if we're going to cut rates 6 out of 8 meetings next year, but the economy is still supposed to be strong, the consumer is going to continue spending, the labor market is holding up, blah, 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 blah. Why in the world do we need to cut 6 out of 8 meetings? Something about that isn't matching. And even if you condense those cuts into, let's say it happens later in the year, if it's still 6 times, that means we're getting some 50 basis point cuts. That's more of a rescue plan. That's not something that is normalizing policy. So something isn't quite matching up. The other inconsistencies, and I put this in the note that's called 525,600 minutes. Those of you that are Broadway fans, you will now have that song in your head for the rest of the day. What a difference a year makes. So you've got the first chart, if we can just bring that up. December is one of the times where we get the Fed's summary of economic projections. The blue bars are last December. The magenta bars are this December. So basically, things turned out a lot better than even the Fed thought. And they turned out to be behind the 8 ball on that. A lot of us turned out to be behind the 8 ball on that. What I heard from him yesterday, again, is that so this year they were not as optimistic. They were worried that inflation was going to stay higher. It came down faster than they expected. They were worried growth was going to slow. It actually stayed stronger than they expected. So for 2024, they're like, you know what? Maybe we were wrong. Maybe things are going okay. And they changed their projections a little bit to look more optimistic as if we're baking in a soft landing. But then if you go to the next chart, you can see where the Fed is telling us, this is that famous dot plot. The Fed is that blue line. So that's the median of the dots. Each dot is a voter. That's where the Fed is telling us rates are going to be in 2024, at the end of 2024. The market is the red line. The market is like, nice try. You got closer, but not quite. And this is where I think we're going to see 2024 be an argument between the market and the Fed, which I'll get to use one of my favorite sayings, what came first, the market or the Fed?
Nice.
I'll use it all the time in 24. But the market is still arguing and saying, no, we want more cuts than that. We want more cuts than that. And I think people just aren't quite playing through what that means. I don't think we want more cuts.
Guys, so this is like a season of love for Jerome Powell.
Season of doves is what I called it.
Oh, all right. Fair enough.
Season of doves.
Guy, what do you make of that? Okay, so like you and I have talked about this a bit. 2023 was almost the mirror opposite of 2022, right? And if you think about how bearish people came in this year, how focused or consensus was for a recession in 2023, the whole idea that Liz lays out in this chart in particular, what's at odds with each other, what the market is saying and what the Fed is saying, I mean, something's going to have to give. Do you expect this to be a very volatile period? Because I guess the easy work has been done, and if we're in the throes of a blow off, we know how blow offs end up resolving themselves. I guess.
I think it's I think the theme for 24 might be we've seen volatility in currencies, we've seen volatility in commodities, we've obviously seen volatility in yields globally. I think 24 is the year we're going to see renewed volatility in equity markets, and that's going to be the upside and the downside. So I think getting back to the word we used before, that complacency that has permeated the market this year correctly for the most part is going to be replaced next year. And I look at this and it's interesting. I love this stuff. I could look at it all day, but the outliers that have been there for quite some time, and the outliers meaning those single dots to the upside, they've gotten themselves in line. So everybody seems to be aligning themselves now. And, one can say that alignment might be the beginning of something new moving forward. So when, you had a lot of people seemingly not off sides, but with varying degrees of certainty or expectations, or seemingly coming around to a point in time where everybody is seemingly on the same page, that might be the time when people shouldn't be on the same page. Somewhat counterintuitive, but that's how I look at this as well, Dan.
Well, I mean, that's how Jeffrey Gundlach was. Let's look at a part of the equity complex that has been very sensitive to these rate moves, and that would be small caps, right? So the Russell 2000. Let's look at the IWM. We have a 1-year chart. Look at that guy to the penny where it stopped, right? So that's a 1-year high. And if we want to look at, maybe those guys can pull up a 5-year chart, and to the sort of volatility that you're kind of talking about that we might see in the S&P or the NASDAQ. I mean, look at how the Russell, which is still significantly below its late 2021, just look at that year and a half, you know what I mean? And what's happened over that period of time, just numerous, 20% drops and pops and the like here. And again, if you think that this has legs, rates go lower for the right reasons, and equities are going to play catch up or are going to be reflected in a more stable economic environment, then you're going to want to play catch up here. I'm not chasing them here. I just think it's important to bring that up, Liz.
Yeah. I mean, obviously, I watch small caps very closely. Looking at this chart as a longer term chart, it's almost clear that they're in a trading range. I mean, it's a wider range, but it's a range. And if you look at the big recovery that happened in 2020, that's how it should work for small caps. We had a recession. We had a deep drawdown. The market was down 35%. They bounced the hardest on the other side of that. That's exactly what happened. And then they stayed elevated for a while. But now it appears that we're just kind of stuck here because, again, respect the cycle. We don't know that we're in early cycle behavior. I find it really hard to believe that we can get back to early cycle behavior without some kind of speed bump. So small caps just still can't quite get off the mat in a decided fashion.
I look at this quickly, Dan, and it's interesting. I'm glad you brought this up because the levels that we're at now, this is the levels, and you can see it in the chart. We topped out at August of 22. I mean, the tops are right there. And if you go back to the other chart real quick, but also, and there you go, those are the tops. Now toggle back quickly. Now you see that prior high, as Elizabeth just said, early in 2020 was basically the same support we traded down to over the same period of time. So as she clearly outlined correctly, we're in a very well-defined range. But I think the question people should ask here is, all right, obviously very economically sensitive. The tailwind of lower rates should theoretically help, but it's also on a backdrop where throw last week's unemployment rate going lower out for a second and just listen to the commentary that we heard again. And I'm not making Hasbro out to be the market, but seemingly on a weekly basis, we hear from two major companies about cuts in employment and job cuts for a myriad of different reasons, none of which matter if you're the person getting laid off, but it's happening right before our eyes. So one has to ask themselves, I think, how can small caps continue to have this type of trajectory higher and a backdrop of what's going to be higher unemployment and slower growth? So that's how I look at this, Dan.
One of the other things, the other contradictions or the things that's inconsistent is when we got the summary of economic projections yesterday, I think the Fed was consistent because they projected GDP for next year as 1.4% growth, which is below trend, right? Trend is somewhere between 1.5% and 2%. And they've been saying for a long time, we need a period of below trend growth to take care of inflation. Okay, fine. So 1.4% next year. And now the Fed doesn't make fundamental projections for the equity market, but 1.4% GDP growth in an economy 70% driven by the consumer in a year that we're also expecting 5.5% revenue growth on the S&P and 12% earnings growth. One of those isn't going to, like, the math doesn't math on that. So I don't know where it's going to come from. Either GDP is going to have to surprise way to the upside versus what the Fed thinks, or earnings and revenue growth is going to have to surprise to the downside.
Yeah. And, there's a headline guy, I'm sure caught your attention this morning, IEA, on oil demand and what it's kind of signaling as far as weak demand and for global growth. And I just wanted to pull up the XLE here for a second, because this is also a sector, if you just look at the energy select, and we know that large integrateds are a big part of that. They were trading very near, those all-time highs. I think those were all-time highs, right? And you see that, we had that rejection, and now we're below that uptrend that's been in place for more than a year or so. And to me, just that's purely technical. That doesn't look great in my opinion. And that looks like a really heavy chart, but it brings me back to a year ago, when people, people were pretty geeked up about this group, and it's performed pretty decently, but it seems like it's churning a little bit. And is this an area that you want to place a similar sort of emphasis as you would, let's say, on small caps, as kind of getting a read on the economy here?
It's amazing. Again, one of the, amongst many confusing things, energy has been that for me this year. We started the year, I was very optimistic of energy. That looked pretty smart at the time. And as we got into the summer, I was feeling pretty good about things. Obviously, the world changed considerably for the underlying commodity, but you still have an energy space, which I get it. It's challenged in terms of demand. And obviously production, I think, has surprised people. But you also have, and we've talked about this, I don't want to belabor it, but you also have M&A that we haven't seen in the space for quite some time over the last couple of months. And again, I think it was today that Warren Buffett announced an additional purchase of Occidental Petroleum, which now has a stake, I think, north of 27%. So something just doesn't add up. You know, you have M&A in the space from some of the biggest companies in the energy patch. You have Warren Buffett making a pretty big play in the space himself against a backdrop where seemingly global growth and the China problem is weighing heavily on not only the commodity, but the underlying equity. So I wish I had a good answer for you. Unfortunately, I don't. But looking at this chart, you're right to point out that it does not look particularly good.
All right, let's hit Toll Brothers here because this is actually one of the more confounding things if I'm looking at home builders today. And again, the headline was that the 30-year mortgage is back below 7%. We know it ticked up to 8%. We know a year and a half ago it was below 3%. We know the supply demand dynamics. I mean, this thing is up 50% in less than 2 months. Okay. So just think about that. And to see, this CEO basically having a hissy fit that his stock is still cheap, okay, relative to that's what he's essentially doing by announcing this buyback. Okay. Now, it doesn't mean that they're buying the stock back at an all-time high, up 50% in 2 months, Liz. But when you see this sort of behavior in a sector that you would think, even where rates are right now, like it's not a great place given where the consumer might be. You know what I mean? It's not a great place to be piling into these names. I mean, this seems like an accident waiting to happen. People bookmark that comment right here.
Yeah. I mean, I think there's probably a lot of accidents waiting to happen out there, especially with charts that look like this. But you know what? It will happen the same way that it happens every time the market goes up, especially in this aggressive of a fashion. People will get FOMO. I think all of us, if we're really being honest, have had moments of like, wait, what is going on? Am I missing it? People will get FOMO, and right at that moment where everybody gets FOMO, it moves in the other direction. Now, we've talked about housing. We've talked about housing adjacent stocks. We've talked about home builders quite a bit. Home builders is one of those sectors of the economy that, much like semiconductors, when there's enthusiasm, it's just going to run. And you got to let it run, right? If you're in it, kudos to you. It's just about making sure you can call the inflection point on the other side and being rational about it, right? Yes, mortgage rates are down. I've actually talked about this on CNBC a little bit, that one of the strange things of this cycle is because it was so driven by rates, we all expected housing to fall, but then the housing market just froze. It didn't really go down. So it froze. As rates come down, you've had all these people waiting, chomping at the bit to buy a house. Rates will come down, they come back in. So I think you actually see a surge for a minute before and if the economy falls apart, then you
just
see
to
it.
be really clear, on Monday, December 4th, on the market call, I did a bearish trade idea using options in January expiration on Toll when it was trading at $88. Here it is, people, at $104. I'm glad that I was looking at a put spread and I defined my risk. I also signaled that I wanted to use a 50% premium stop on that. I am obviously stopped out. And if you weren't stopped out, it's a dead bang loser all around. All right, let's do it. If it's Thursday, Guy, it's...
Well, you know what it is. It's Butters.
It's Butters. Okay, so John Butters, he is the senior earnings insight analyst over there at FactSet. He gives us a preview on the Thursday market call of his earnings insight blog that drops on Friday. You guys know where to find it. You can get it over there at FactSet. So Butters, Guy, is looking at, what is ultimately consensus for 2023 earnings and revenue growth. We are expecting 0.7% for the S&P 500 calendar 2023 compared to earnings growth of 4% for calendar year 2022. 8 sectors are expected to report growth rather by consumer discretionary. 3 sectors are expected to report a decline led by energy. Okay, well, that is backward looking. Let's focus on 2024. Okay, we all have a good sense of 2023. Analysts expect the S&P 500 to report double-digit earnings growth in 2024. Estimated year-over-year earnings growth rate is 11.8%, which, Liz, you just mentioned, above the trailing 10-year average earnings growth rate of 8.4%. Analysts are expecting the highest earnings growth in Q4. So, Guy, it's back-end loaded in 2024.
Well, it better be heavily back-end loaded because, to Elizabeth's point earlier, the math, it's math. And the math, given the projections for GDP, that it just doesn't add up. And oddly enough, in an inflation environment where things are slowing down, I'm not saying that's going lower. Inflation is not going lower. The rate of growth is slowing down. that's typically a headwind for earnings, somewhat counterintuitive. So none of this, these projections are fine, but the math doesn't add up. And by the way, what Elizabeth said, eerily reminiscent of what Doug Cass said, and I'm not suggesting they probably didn't even see each other's emails, but Doug Cass pointed out the same thing that Liz did, and I'm just pointing out the obvious, that there's no way the math works with these expectations.
Well, earnings and revenue are also suggesting margin expansion in 2024. And again, the math on that, if you've got revenue growth 5.5, you've got earnings growth somehow double that, margin expansion, unless we've got this huge surge in spending that nobody sees coming, margin expansion really only happens if they're cost cutting. And as far as I know, they've cut costs everywhere they can. They've cut ad spending, they've cut marketing, they've cut a lot of overhead. There's been cuts across the board. Where they haven't cut yet is labor. And I think that's the only thing left, which is what we have to watch.
Yeah, and I'll just push back for a second there. The dollar coming in, yields coming in. I mean, like that certainly helps margins on a whole host of sorts of, different sectors and companies and the like here. So again, we're going to continue to track both of those things. Listen, people ask us all of the time, where do we get these tricked out charts and analytics, and how do you get access to all these news stories? Well, right there, people, at FactSet, they are a fine sponsor and data partner, and you can get yourself a free trial and check it all out yourself. Go to FactSet.com/LP/MRKT-call. Look at that. Check it all out there. Guy, that's it, man. We covered a lot.
We covered a lot. And, we started by our mea culpas, and I think we've been consistent with that. And I do, listen, it bothers me. I mean, you talk about the things that keep me up at night. I mean, these are the things that keep me up at night. We take a great deal of pride in the work that we do and the research we put into it and the effort we put into it. And you obviously want to be right. I mean, I don't want to be right for the reasons I am, but you want your work to mean something. So I throw that out there. But again, you got to stay with it, because despite the fact that there's this euphoria out there now, in my world, I think your world, and some of the things that Elizabeth said, nothing really has fundamentally changed in terms of the backdrop. Anyway, that's it. I do want to thank EY from SoFi. I want to thank the audience. Dan, Nathan, we won't be back tomorrow being Friday, unless something weird happens, weird being a weird word in and of itself. But we'll be back on Monday. And by the way, we have our podcast that will drop tomorrow. We have Stuart Sopp of Current joining us, Dan.
Yeah, we do. And we also have EY from SoFi on us on the Monday edition of the On the Tape podcast. So check that out, people. If you're not subscribed, check it out. Also, you know where to find Liz on the Twitter. That's at Liz Young Strat. Guy and I are on the Insta. He's Guy.Adami. I am, what am I, Dan S. Nathan. There's all the stuff. Go follow it. We're putting a lot of content on there. So we appreciate the follows. We appreciate you checking us out. Have a great weekend, people. We'll see you on Monday.